Greetings and thank you for joining us for this today's presentation. I'm Dave Yeske, and I'm going to be spending just a few minutes talking about recent events, the midterms, what's going on in the markets, and what the implications are for you and your money. A few housekeeping items. I wanted to mention that there is a if you look at the GoToWebinar panel that appears on your screen, you'll see there's a section called Questions, and we invite you throughout this presentation to type in your questions, and where appropriate, we'll try to get to them. I'll try and get to them in real time, and if nothing else, we'll definitely get to them at the end. And in fact, we'll have an extended period when we get to the conclusion where you can type questions and comments and make this as much of a dialogue as you would like. So anyway, let's get started. So we're going to talk first a little bit about the recent election and the implications that may have for the economy and the markets and maybe life in general. We'll specifically spend a little bit of time on what the markets may be telling us. There's sometimes what the markets are telling us is just noise, and other times there's information embedded in that. So we'll explore that question a bit, and we'll also talk about some of the key economic variables that we think are going to be important drivers of the sort of evolution of the markets in the coming year or two. And finally, we'll talk a bit about how to think about all this in terms of one's personal affairs. How to ensure that you maintain some resilience in your life and are able to sail through the sometimes rough waters that we inevitably face. Whoops. So first of all of you who follow politics, and that's probably everyone who's watching, you know that in the most recent midterms, as of November 6th, that the Democrats have, in fact, as predicted, taken control of the House. This is one of those elections where, to a significant degree, the prognosticators were correct. They predicted that the Democrats would take control of the House. Even the margins by which they predicted that were pretty close. There's still a number of undecided races, but it looks like the Democrats may get as high as 235 representatives. And so all of a sudden now we're moving into divided government in Washington again, and that has a lot of implications. Also, as predicted, the Republicans have retained control of the Senate and have actually picked up at least one and quite possibly two seats. So retained control and gave themselves a little bit of a margin over what they had before, and that's obviously going to have implications as well, especially when it comes to things like appointees to the federal bench. These are approved by the Senate. The House doesn't really get involved. So some things will continue as before, but many things won't. It's popularly believed that the markets, and for that matter the broader economy, benefit from gridlock. That when you have gridlock in Washington and politicians are left unable to initiate any significant new legislation, that can be good for the economy and good for the markets. Sort of leaves the rest of the population to decide what's going to be happening without a lot of steering or new incentives coming from Washington. Having said that, there's still a not insignificant possibility, if not probability, that there is room for some bipartisan legislation, some initiatives that where there could be agreement among the parties. Now, where that won't be are among some of the Democratic priorities. Obviously, Democrats would like to strengthen the Affordable Care Act. There are ways in which it has some weaknesses and some cracks that have been showing because they were never able to be corrected over the years because of prior gridlock. That's not likely to happen. I think that there's I think there's absolutely no appetite on the Republican side to make any significant changes to the ACA. Democrats would also like to impose carbon emission taxes, and that's basically a non-starter on the Republican side. And they've said they would like to restructure the 2017 tax cuts. Likewise, notwithstanding the fact that those ultimately proved surprisingly unpopular with the population in general, there's probably again very little appetite on the Republican side for making any changes there. Where there is room for bipartisan accord is in the area of infrastructure spending. This one would be kind of tricky because infrastructure spending at a time when there's already a lot of fiscal stimulus as a consequence of the tax cuts. There are a number of different ways you can stimulate an economy. You could do so through the monetary tools, generally wielded by the Federal Reserve or any central bank if you're talking about other countries. And that involves things like the primary tool involves lowering interest rates in order to stimulate business investment and consumer purchases. The Federal Reserve is obviously going in the opposite direction with that now. The other way is fiscal stimulus, and that's where you either lower taxes, which Congress did last year, or spend more money, which would be what would happen if there was a new infrastructure spending initiative. Because the economy, as we'll discuss in a moment, is growing at a fairly rapid pace, partly as a consequence of some of the stimulus we're talking about, including last year's tax cuts, one has to question how much room there is for additional spending before it builds up inflationary pressures. The other element is that we have an incredibly low unemployment rate. It's currently at 3.7%. So yet again, if you want to increase significant infrastructure projects, you're going to be employing more workers, and to do that, you have to have workers who could be mobilized. And if you don't have a lot of unemployed workers with the appropriate skills, then these projects start competing with private business, and all of a sudden you get wage inflation because everyone's trying to outbid everyone else in order to hire this finite group of workers. So it's an interesting question. It's something that probably would have been incredibly helpful back in the day, 10 years ago, as we were recovering from the Great Recession, and unemployment rate was extremely high, and there was a lot of slack in the economy, a lot of room for additional stimulus. Right now, it's hard to say what the impact on the economy would be, but it may be that there's not as much room as we'd like to mobilize this kind of a project, and that's unfortunate because there is a huge need for infrastructure spending. Both airports, we have crumbling bridges, crumbling roads, and one of the things that's well established in economics is that when you invest in upgrading your infrastructure, the interstate highway system and the bridges and the airports and the ports, when you invest in those, you actually raise the potential growth rate of the economy. So, this is the kind of thing that should be treated as investment more, or thought of as investment more than deficit spending or more deficit spending. But again, there's a big question mark about whether the current state of the economy can really support that. Prescription drug prices is another area where it looks like there may very well be some common ground between the Democrats and the Republicans. Prescription drug prices have been rising at a seemingly out of control rate in recent years, and it's become a mini crisis for a not insignificant part of the population. So expect to at least see some initiatives there, and in fact, there may ultimately be some bipartisan legislation, I should say. Middle class tax cuts. President Trump has talked about that. The tax law changes last year were to a very significant degree aimed at businesses, publicly traded businesses, real estate businesses, and they were not particularly focused on middle class Americans. So President Trump has talked about wanting to have more middle class focused tax cuts. Democrats would certainly like to do that. One of the problems is how to pay for it, because to initiate additional tax cuts without having some mechanism to finance them, you're just going to increase the deficit even more. And those of you who follow the financial news already know that the projected federal deficit this year is expected to be double what the original projection was prior to the tax cuts. So having already initiated a round of tax cuts that have in 1 year doubled the national, pardon me, the debt, the federal debt, or the federal deficit, I should say, increasing that may not be the smartest thing to do at the moment. So we'll see where we go on that. But it may be they come together and say, you know, we're just going to run the deficit even bigger in order to give some tax relief to the middle class. So let's talk for a moment about what we're seeing in the stock market. This is a measure of the global stock market, the MSCI All Country World Index. It's essentially like the S&P 500 in the U.S., but it covers all countries in the world, including the U.S. So again, those who are paying attention to the news have noticed that we've had a lot of volatility in the market in the last month or so. But what's interesting to see is that if you look at the last year, things are basically unchanged. You know, the markets have gone up, the markets have gone down. They've been very choppy with very large moves on a day-to-day basis. But in fact, we're basically where we were a year ago across the globe. And it's always important. You know, we talk a lot about what happens in the short run, and by the short run we mean, you know, in a given day, week, month, or even year. Most of what you see is just noise. Most of what you see, all the ups and downs on a daily, weekly, monthly basis, are just investors and market participants trying to absorb and interpret the daily news that rolls in. And of course, the news rolls in on a kind of a random basis. And one day one day investors, it makes them more optimistic. The next day it makes them more pessimistic. And all of those daily ups and downs are kind of meaningless. They don't give you a real insight into what's going on deep beneath the surface. And so this, again, is another example where in reality, not much has happened over the last year, even though it may feel like it, especially with the heightened volatility of the last month or so. So this is what's gone on just in the last couple of weeks. Obviously, we had quite a dip. This one move there, that is November 7th. That's the day following the midterm election. You know, a lot of people declared that was investors being really happy about divided government. So we had a nice pop in the market. But on the other hand, it didn't last. And in fact, there's a very important degree to which you have to remember that correlation does not equal causation. You know, if you read the newspapers or you watch the nightly news on TV, you're always being given an explanation for why the market went up, why the market went down on any given day, and by and large, those explanations are worthless. You know, people are always looking for an explanation, but we don't really know, except with 20/20 hindsight, why the markets did what they did. And in fact, some of it, again, is just some of this noise that has no real implications for what's going to happen in the long run. Staying with the global stock markets, I think it's worth noting where we stand valuation-wise. Now, this is a measure of forward price-to-earnings ratios. And price-to-earnings ratio, it's an attempt to measure how expensive an individual stock or an entire stock market is. And it's a measure of how much you have to pay when you're buying shares for $1 of earnings. These are forward-looking measures. And I apologize for the sirens. I'm broadcasting from downtown San Francisco, and it sometimes gets a little noisy here. Hopefully everyone's okay. I'm not sure what's happening, but okay. Okay, so I am, Excuse me, I'm just making an adjustment here to make sure I can see your questions. Okay, so price to earnings ratios, they're an attempt to measure how expensive a stock is. They're an attempt to measure how expensive a market is. These are forward looking. So this is a measure based on projected earnings for the next 12 months and the given price level of the market. Now, what you can see if you look at this list, let's start at the bottom. Uh, the U.S. stock market is still the most expensive of the major stock markets, sporting a forward-looking price-to-earnings ratio of nearly 16, and emerging markets are the least expensive. And emerging markets have suffered a bit in the last 6 to 9 months. A number of things have happened. Again, we'll talk more about this in a few minutes, but rising interest rates in the U.S. and the rising value of the dollar has created stresses for emerging markets, not least because many of them, including, for example, Turkey, borrowed heavily in dollars. So they took out loans that were denominated in dollars, and so they have to repay those loans in dollars. And that means that if the value of the dollar has risen relative to their currency, like in the case of Turkey, the Turkish lira, that means that if the dollar rises by 100% against the lira, it means that it costs them 100% more to service their debt because they have to trade lira for dollars in order to make their debt payments. So that's been a bit of a stress for emerging markets. That also included a slowdown in China and some impact from the threats of tariffs and trade wars, which again, that's another thing we'll talk about in a few minutes. But what's notable is that most markets outside the U.S. are trading at lower valuations than the U.S. market. So while it's true that the U.S. market has in historical terms is pretty highly valued, in historical terms, markets outside the U.S. much less so. That means there's a lot more opportunity and a lot more upside for a global investor, and it's one more reason why it's really important to be a global investor and spread your risk outside the U.S. One of the things that we do at Yeske Buoy is we take an approach that we call geographically neutral. When we're designing a portfolio, we like to allocate the portfolio to countries and regions in a way that's proportional to their share of the global stock market. So since the U.S. stock market represents about half the value of the global stock market, we allocate about half the portfolio there and the balance outside the U.S. So it creates this geographic diversity where we're investing in markets that have diverse valuations and diverse potential for growth in the coming months and years. And here is an example. Here's what we think is kind of an interesting example of what that kind of diversification can mean. So a month ago, we were about to meet with a client, and we were looking at the 12-month returns to the various components of their portfolio, and we asked ourselves, that's interesting. I wonder what the 12-month return was prior to the last 12 months. And you can see here that the 12 months ending September 28th are represented by the dark green bars, and the 12 months preceding that are represented by the light green bars. And what's fascinating to note is that the leadership completely flipped. The big leaders 2 years ago were the laggards in the last year, and vice versa. And you'll see that this actually plays itself out internationally as well. If you look at the bottom, you'll see that 2 years ago, the international small company value stocks, the emerging market stocks, the international stocks, the international value stocks, and the international small, all of those had the highest returns. They had returns of 20 to 25% during that 12-month period. But then in the most recent 12 months, things completely reversed themselves. And the overseas markets had very modest returns. In some cases, they had negative returns. And the U.S. markets had different components that had 20 to 25% returns, especially the small company stocks. So this is the kind of thing we actually look for when we're building a portfolio. We want to bring together components that have a positive, attractive positive return in the long run, but that don't necessarily all move in lockstep in the short run. If you have a portfolio filled with things that are all doing the same thing at the same time, it's not diversified. They may all be going up at the same time during some period, but that means they'll all be going down at the same time in another period. Anyway, we just thought that was an interesting example we wanted to share. So now let's move to some of the economic factors you're going to want to keep an eye on going forward in the U.S. First of all, the leading economic indicators, the most recent measure of the leading economic indicators, shows an increase of 0.5%. This is in September. And this is after the leading indicators rising 0.4% in August and 0.7% in July. So what this tells us, this is an index that's composed of many different, a combination of different economic series that's intended to give a view as to what's going to happen in the economy 12 months out. And one of the stock market is among this. Employment, there are I think it's 12 different measures. I was almost going to list them, but I thought that might be too much detail. Anyway, so what they're telling us is that the outlook for economic growth in the coming year in the U.S. is still very positive, but that the growth in the leading indicators is slowing. And this may be because of some constraints and some bottlenecks that we've talked about. The shrinking unemployment rate, the rising interest rates, and some of the pressures that those put on the economy, but still positive for the coming year. Economic growth was 3.5% in the third quarter, and that follows a second quarter in which the annualized rate was 4.2%. So we've been seeing very strong economic growth this year. Again, a couple of reasons for that. The corporate tax cuts last year likely represented a portion of that, because all of the things being equal, when you give corporations a tax cut, their earnings rise, and when their earnings rise, the valuations rise, and they then have more money that they can spend in investment, and some of it got spent in stock buybacks, which is not quite as good for the economy, but some of it materialized as increased corporate investment, and that also helped contribute to a higher growth rate this year. We'll talk more about that in detail in a minute. The Federal Reserve governors have continued to raise short-term interest rates in the form of the federal funds rate this year. They just met a few days ago, and they declined to increase rates at that meeting. Rates currently operating at a range of 2 to 2.25%, but they did indicate that it's likely they're going to raise them again in December. They would likely move rates up 0.25%, which would create a new range from 2.25% to 2.5%. And they likewise signaled that they'll probably continue with their plans of raising rates at least 3, possibly 4 times in 2019. The U.S. dollar has been very strong this year, and that's something that can affect a lot of things. It has an impact on economic performance within the U.S. When the dollar rises in value, a couple of things happen. Imports become cheaper, but exports become more expensive to foreign buyers, and so that can have a negative impact on American companies that produce goods for export. Big companies like Caterpillar, for example, which I think more than half of their sales are outside the U.S. Well, when the value of the dollar rises against other currencies, it becomes more expensive for developers in Southeast Asia or anywhere else in the world to buy Caterpillar equipment, and therefore it potentially puts a crimp on their export sales. It also has a potentially negative impact on the investment returns you earn on your foreign stock holdings or any other foreign investments. I'll give an example of that momentarily. So let's look at the trends in the economic growth rate. In 2015, growth was close to 3%. It was 2.9%. It was a bit slower at 1.5% in 2016. Rising in 2017 for an annual rate of 2.3%, and this year is projected to be close to 3% again. The latest projection is that for the year as a whole, the economy will grow by 3%. Now, you can't add up these bars. Those numbers look like they're too low based on the size of these bars for the quarterly rates, and it's important to remember that these are not the actual rate in that quarter. This is the annualized rate of growth that was measured in that quarter. So it's like if you took that rate of growth and multiplied it by 4, and of course that's never what the final year looks like. But nonetheless, it's been attractive. It's been growing. Things are, most projections show economic growth slowing a bit next year, dropping down to maybe 2.7% growth rate. And then thereafter, most projections have the economy returning to about a 2.2% growth rate, which is really our the long run trend. It's what we've seen in general since the end of the Great Recession, and and based on the current structure and maturity of the U.S. economy, it's thought by most economists to be the long run sustainable growth rate, 2.2, maybe 2.5%. If this current expansion continues through June of next year, it would become the longest period of economic growth, continuous economic growth since 1857. It would at that point supplant the last longest period of growth, which was 1991 through 2001. So that was the last time we had 10 years of continuous economic growth. All signs are that we will, in fact, hit that target and set a new standard. As I said, next year the growth rate is projected to slide a bit to 2.7% and to slide further to 2.2 thereafter. That's absent any additional stimulus. Infrastructure spending might goose that a bit. But again, then we run some inflationary risk. So that'll be one to watch very carefully. That low unemployment rate and rising interest rates, those are really going to be the bottlenecks for future economic growth. And it's going to be a bottleneck for major initiatives like those infrastructure initiatives. There's something that's worth noting though when you look at a low unemployment rate such as we have now, which is the lowest we've seen since the 1960s. It's also a function of the labor participation rate, the labor force participation rate. So this says that 3.7% of the people who are in principle in the workforce or would like to work are not currently employed. But in fact, the number of people who are in the labor force has been dropping. You can see back in 2000, more than 67% of the adult population was in the labor force, was participating in the labor force, and that has since dropped to below 63%. That's 4.5% of the adult population. That's a huge number of people who, if they came back in and joined the labor force participation rate, would raise the unemployment rate, but would also create a lot more slack and a lot more room to create more jobs. Interestingly, I read a study just a few days ago about some structural differences between the U.S. and Canada. Canada has much higher labor participation rate than the U.S. does, and this study was able to pinpoint the difference, and the difference was in working age women. And the structural difference in Canada that has allowed a much higher participation rate by working age women was that Canada has a vastly different set of policies, both at the government level and at the corporate level, for allowing flexible work time and accommodating family responsibilities. So that's an area where some structural change in the U.S., either on the part of companies or maybe with some nudging from the government, could potentially create conditions where the labor force participation rate would rise. It would create more growth opportunity because it's the rise in the number of workers that's one of the inputs to economic growth. You can get that a couple of different ways. You can either create the conditions where more working age women can actually join the labor force, or you can have much more liberal immigration policies, because that's another way in which you can support economic growth, is by increasing the population through immigration. And that has a double impact. first of all, when you liberalize immigration, you just get more people coming in who can join the workforce. And secondly, immigrants tend to have higher fertility rates than Native American, the people who were born here, and as a consequence, they also, with something of a time lag, but they also um, add to a growing population that again is a necessary input to economic growth. So inflation expectations, they've been rising since 2016. You can see there was a low point there in 2016 where inflationary expectations were below 1.5%. Currently, they're running about 2.2%, 2 to 2.2%, and these are forward-looking expectations. These are 5-year forward inflationary expectations. It means that these are the expected inflation rates for the 5 years, beginning 5 years from now. And the ways in which the Federal Reserve measures these is they look at Treasury inflation protected securities. Those are TIPS. And those are Treasury bonds that are specifically designed to adjust for inflation. And the way they adjust is that the price of the bond goes up by the inflation rate every year. And so as a consequence of that, they have lower yields. And so economists can look at traditional treasuries where your only return is going to be from the interest yield, and they can compare them to TIPS, and they can infer the future inflation expectations of investors by doing that. So as you can see, forward inflation expectations are fairly stable at plus or minus 2%. They're actually the most recent measures have been actually right around 2%, which is the Federal Reserve's preferred inflation rate. Inflation can have a little bit of inflation is a good thing. Too much inflation is a bad thing. If you get into double-digit inflation, such as we had back in the late 70s, early 80s, that can have some very negative impacts on an economy. And there have been some South American countries that have had 1,000% inflation. There's a most recent case of 1,000,000% inflation rate, which makes it basically causes the economy to grind to a halt. But a little bit of inflation is a good thing. It kind of greases the works. This is one of the reasons why the Federal Reserve, back during the Great Recession, was actually very worried about the economy slipping into deflation. Deflation is a condition where prices are going down. And expectations of future prices are that they'll go down, not up. Well, if consumers think that prices are going to go down, going to be lower in the future, they tend not to buy now. Why would you buy something today if you thought waiting for a month or 6 months or a year would allow you to buy it cheaper? Well, so all of a sudden that causes consumer demand to fall, that causes economic activities to fall, and you get into a negative downward spiral. So that's why a little bit of inflation is a good thing, because if you think that things are going to be a little bit more expensive if you wait 6 months or a year to buy them, you might be more inclined to make those purchases today, or at the very least, you won't be incented to defer those purchases. As I noted earlier, the Federal Reserve has been raising the short-term interest rates in the form of the federal funds rate. And you can see this started back in 2016, and they've been rising quite steadily. And if we look at this same chart a year from now, I think you'll see that it's probably much closer to, or maybe at 3%, which seems to be kind of the target. The Fed's feeling is that that's kind of you can't see my air quotes, but that's kind of a normal interest rates for risk-free interest-bearing investments. So you can expect, barring some economic reversals, if we have continued volatility in the stock market, if we see any kind of reversals in economic growth, the Federal Reserve is certainly they're certainly watching very carefully, and they might adjust the schedule by which they raise rates. They might even suspend rate increases. But if all current trends continue, you can expect to see the Federal Reserve continue to raise those rates in the future. And longer-term interest rates have been rising also. If you look at the 10-year Treasury, which is a benchmark that a lot of things that's used to price a lot of things, including mortgages, that's also continued to rise. And to the degree that economic activity and inflation continue to rise, you can expect to see those 10-year Treasury rates rise as well, and that has implications for mortgage borrowing and the rest. So let's talk for a moment about the dollar, because this is one that's really worth watching. There's a dollar index that measures the value of the U.S. dollar against a basket of other major currencies from around the world. This was a spike in the value of the dollar back in 2008, 2009, at the depth of the Great Recession. And that was happening for a couple of different reasons. One of them was that there was what's often referred to as a flight to quality, where the entire world was in a panic, and investors who needed to park money somewhere generally wanted to park them in U.S. Treasuries, which are seen as the safest asset on the face of the earth, and probably is the safest asset on the face of the earth. Well, the only way you can buy U.S. Treasury bonds, is with U.S. dollars. And so you had foreign investors who had to trade their currency to U.S. dollars. They had to buy U.S. dollars so that they could then park their money in treasuries. And all of that buying activity caused the value of the dollar relative to other currencies to spike. And then in late 2014, you could see we got into another significant rise that's persisted significantly since. It started to fall a bit. It started to fall a bit 2 years ago. But as you can see, this is the last 12 months, and you can see that it's been rising again. And again, there are a couple of implications for that. There are implications for the U.S. economy, for domestic companies that are big exporters, but there are also implications for investors. And so I'm just going to give a brief example of why that is. Imagine that you invested some money in the United Kingdom, in Great Britain. And in a given year, your investment in the UK grew by 10%. Well, at some point, you have to translate that return back into US dollars because you are a US investor. And in fact, if you're one of our clients, as you know, we report all of your portfolio returns in dollar terms on a monthly basis. Well, when it comes time to report back to dollars, all of a sudden the exchange rate becomes a factor. In this example, imagine in a given year, your UK investments in local terms, in pound sterling terms, grew by 10%. But over the course of that same year, the value of the dollar rose 10% against the pound sterling. Well, when we translate that return back into dollars, in dollar terms, it's not 10%, it's only 9%. So a tenth of your return was shaved away just through a shift in the exchange rate. Now, exactly the same thing works in reverse. If the value of the dollar falls against the pound sterling, if it fell by 10%, well, that 10% return that you earned in the UK, when it gets translated into dollars, it's not 10%, it's now 11%. So shifting value of the dollar against other currencies, it can cause your overseas returns to either be reduced or increased. Now, on average over time, if we looked at a chart of the dollar, and I was intending to show one, I don't think I included it, you would see that it fluctuates. It fluctuates in a kind of a random fashion, and so notwithstanding the recent strength, over the longer term, it will tend to go up, it will tend to go down, and we think that over the long term, it tends to cancel out. But it is actually a source of diversification, and I'll talk about that in a moment. So let's talk about some global factors that are going to be worth paying attention to. One of them are threats to international trade, and this is one of the things that's been roiling markets. We can speculate about what investors are worried about and why markets have become more volatile recently. Certainly, some of it may be concerns about rising interest rates in the U.S. Some of it is tied to concerns about the impact of a rising dollar and the impact that has on overseas markets and especially emerging markets. But a not insignificant part of this has been concerns about tariffs and the possibility of trade wars. Right now, President Trump and his administration, while they have been busy renegotiating the North American Free Trade Agreement, and it looks like they have in fact come up with a new agreement with Mexico and Canada that all three parties can agree to, there still is a lot of strife with China. What's unclear is whether the Trump administration is viewing China as an international threat to the U.S. dominance of the world economy, and therefore trying to sort of tamp them down uh, through restricting trade, or if they simply think trade has been unfair historically and would like to renegotiate to make it more fair. If the latter is true, then it's likely that an agreement is going to be possible. You know, our trade the 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 Trade Secretary or the Commerce Secretary Mnuchin is actually scheduled to meet with his counterparts in China in the next few days um, in order to prepare for a subsequent meeting a couple of months from now, or a month from now, I think, between uh, uh, Chairman Xi and President Trump, which might lead to some high-level agreements. So, if the goal is simply to remove some perceived unfairness, then there's a good chance we'll get to an agreement, and some of this uncertainty will 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 be removed from the markets. If there are larger geopolitical goals, then all bets are off, and we'll see what that happens. So that's going to be one to watch. If the U.S. and China in the next couple of months manage to come to an agreement over some of these friction points, then you can see you're going to see a big source of volatility in the market removed. Another concern is Brexit. Um, Prime Minister May has come up with yet another plan to facilitate Brexit, which is scheduled to happen next March. Um, she is going to have to get it approved by her cabinet. There's a lot of uncertainty whether she can. This has roiled overseas markets considerably. You know, it's important to remember that the UK is the fifth largest economy in the world, and it has a very large stock market. Its stock market is even larger than that as a share of the global stock market. And so when you look at the potential for disruptions in in the fourth or fifth largest stock market in the world, both in terms of its interactions with the European Union and the rest of the world, this also has roiled markets, especially overseas. And speaking of the European Union, there's also been some additional volatility because of what may turn out to be a major fight that Italy is having with the rest of the EU, and it's over spending and budget deficits because of the integrated nature of the European Union. There are general guidelines that are that are uh, that are imposed on all the different members, and Italy is saying no. We're actually going to run a larger deficit than those guideline deficits, and so that's creating a big fight, or the potential for a big fight. And again, that's roiled markets within the EU. So that's one that if and when it gets resolved, that's going to remove a source of volatility in overseas markets as well. So those will be three things for us to watch. So let's talk for a moment about just strategic positioning, how to think about these things in terms of how they impact you. I mean, when you talk about trade policies, um, we're living in a world where, especially with respect to U.S. trade policies, which have been pretty radically different since the Trump administration came into control, and they've been, instead of being multilateral, where you have large groups of countries that come together in venues like the World Trade Organization and agree to trading rules across a large universe of countries. The Trump administration has preferred to pursue bilateral agreements, where it's where the U.S. is negotiating individually with other countries rather than doing it through these large multilateral organizations, and that has created some dislocations, but the dislocations have been very lumpy. They vary from country to country and region to region, and so this is one of those things where broad global diversification is really important. You don't want to be overcommitted to one country or another, or one region or another, including the U.S. So diversifying across countries and regions is crucial. Diversifying across groups within those countries, and also diversifying currency exposure. as I mentioned earlier, over the long run, the dollar exchange rate with other currencies, although it's been very strong in the last year and strong and rising in the last year, it does fluctuate quite a bit. And so you want to be dollar diversified as well. And this is one of the things that we do. We do not explicitly hedge against the dollar exchange rate with our overseas investments. And that's why those returns will fluctuate with fluctuating exchange rates. But we think that's actually a source of diversification. Now, when it comes to monetary policy and interest rates, especially if we're focusing on the U.S., we know rates are going to continue, short-term rates are going to continue to rise in the U.S. if the Federal Reserve follows through on its plans. We could expect to see short-term rates at plus or minus 3% within the next year. 10-year Treasury rates are likely to move in sync with that, especially if inflation rates remain at the 2+ level, 2+% level. I think you're going to see the 10-year Treasury rate continue to rise, and as economic conditions continue to tighten with a really low unemployment rate and maybe a little more wage inflation, which we've already started to see. Again, that will be a driver for 10-year Treasury rates. So what are the implications of rising rates? Well, one of them is that you need to focus on short to intermediate maturity bonds, very high quality and globally diversified. We ourselves, in the recent past, in the last year or two, have really shifted almost entirely to the short end because we saw the writing on the wall. We saw that the Fed was resolved that it was going to raise rates quite steadily, and indeed they have, and that we expected that would also be reflected at the longer end, as has been reflected in the 10-year Treasury rate. And so we shifted exclusively to very, very short-term bonds. The average maturities are under a year. Well, bonds are very sensitive to changes in interest rates. And when interest rates rise, the price of a bond will fall, all other things being equal. But if the maturities are really short, they tend to be more or less impervious to rising interest rates. They're much less affected. And so in the face of rising interest rates, we moved very short. As interest rates emerge into what we think of as a more like normal level of interest rates, sort of along the lines of the Fed thinking about normal rates, if we start to see a 3% rates at the short end with risk-free assets like Treasury bills, and rates maybe moving in more in the 4.5%, 5.5% range in the intermediate to longer term range, such as with the 10-year Treasury note. As they move into that more normal range, we will likely diversify our bond holdings back a little bit more into the intermediate range. Maybe 3 to 5 year maturities as opposed to 1 year or less, which is where we are now. So we'll be moving on that, and that blend can vary also based on where someone is in their life cycle. You want maximum stability if you're in the spending phase, because that bond allocation within the portfolio is meant to be a stable reserve to bridge your spending needs through a downturn in the stock market. If someone is years away from retirement, they don't have quite the same need, and they can afford to have a little bit more risk in their bond portfolio. They don't need quite that because it's not acting as a bridge when they're in that pre-retirement phase. So now let's talk about positioning around inflation and interest rates. So as I mentioned earlier, higher inflation, within limits, can be a good thing for both corporate profits, because companies have pricing power. One of the things that we've seen with the tariffs that have been imposed recently is that companies have managed to price the tariffs into their goods. They've managed to raise prices to sort of overcome the higher cost of goods that they've had to buy from overseas. With the recent spike in tariff rates with China, that will become more difficult. But a little bit of inflation gives companies a little bit of pricing power. They can raise rates, and consumers don't always notice it. It also encourages consumption by consumers, as I mentioned. But it has implications. As rates rise, it's worth considering what that impact is on your financing. If you're considering buying something with financing, or if you're considering refinancing your mortgage, for example, we're in a period now where rates are rising slowly, but they're rising, and that's been reflected in mortgage rates and will continue to be reflected. So if if you feel that you're going to want to refinance in the coming year or two, or that you're going to need to refinance in the coming year or two, maybe you have a 5 or 7 year adjustable rate mortgage that's about to go into its annual adjusting phase. It's about to leave that fixed interest rate phase. It would probably be a good idea sooner rather than later to explore those refinancing opportunities. So the other thing to do in the face of all of these unknowns, we want to be living in a space of sort of watchful waiting. But in the face of these unknowns, I think we have to also contemplate the deep regularities. As I mentioned earlier, when you look at the stock market, if you look at it in the short run, you don't really know what's going on deep beneath the surface, because what happens in any given week or month or year is mostly noise. Whatever those deep regularities are, they're being swamped by the noise. And so we like to step back and think about the long term and think about what the real drivers are. And one of the real drivers, a fundamental part of our worldview as an organization, is that human beings are fundamentally growth seeking and resilient. And so that means that the world economy, the U.S. and world economy, are ultimately resilient and biased towards growth. Because the important thing to remember, often when we talk about the economy, you hear it reported in the news, and you hear statistics about the gross domestic product and the GDP deflator and interest rates and inflation rates, and you hear a lot of statistics, and the whole thing starts to feel like a big inhuman machine. But in reality, what the economy is you and your family and your friends and everyone you know and everyone you don't know going about the daily business of earning, saving, spending, and investing. All of those individual daily decisions aggregate up to this thing we call the economy. And so the economy is of necessity and by definition nothing more than a human artifact. It's how we act in the aggregate. So if we are individually and collectively resilient and growth seeking, then the economy by definition has to be also resilient and biased towards growth. The stock market, it's just a reflection of the real economy. It represents ownership of the productive assets of the economy, and therefore, in reflecting the real economy, it must also be biased towards growth in the long run, notwithstanding the noise and the volatility that may manifest in the short run. So, because there's so much noise, and because you can't really predict the future, and the noise doesn't really give you any information, you have to fall back on these long run deep trends, these long run deep regularities, and build your plans around those, and build resilience. And this is one of the things we always aim for, not just in the portfolio, but across one's entire financial life. Make sure you have enough liquid reserves, enough cash reserves for an emergency fund. Make sure you have the right types and amounts of insurance. Make sure that you've made the best choices with your employee benefits. Make sure that your estate plan is reflective of all your desires for yourself and your family, and make sure that you have the right kind of portfolio that's sufficiently diversified and has resilience built into it, so you don't have to guess or predict the future. You can ride it out and sit back and harness those long run deep regularities. And when all is said and done, just don't forget to breathe. That's probably the healthiest thing any of us can do. Make the right plans, build resilience into your full financial affairs, build resilience into your portfolio, and then step back, breathe. Maybe take a break from the news, read something inspiring, or take a long walk with family members and friends. So with that, I guess that was nearly an hour. I shouldn't be surprised. I thought it would be shorter, but we're talking about me. I always give the long answer to the short question and give the long presentation for the short topic. Anyway, with all of that being said, we certainly have time for questions or comments if there are any. I don't see any now. The thing I always like to emphasize is that you don't have to have a question or a comment now. We look forward to hearing from you at any time. If you're part of the Yeske family, by all means, call us up or come into the office and talk to us. If you're not a member of the Yeske Buoy family, by all means, call us up or come into the office and talk to us. We like to meet new people. Um, and so, with that, I will thank you for your attention and for being with us, and look forward to seeing you in the future.